One of the things that I've been watching this week are the inflows into the Bitcoin ETF. Over the last 4 days, we've seen $1 billion in inflows, and we're headed towards a record since the ETFs actually came out.
Wow.
So we're starting to see that the market's been like a coiled spring for months now. We've seen all this development. We've seen institutional interest through RIAs like Morgan Stanley. And now we're starting to see some of that come through in those ETF inflows. And we're starting to see price respond a little bit to those flows. We're getting pretty close to an all-time high here on Bitcoin.
That is great. Have you got any sort of rationale to explain? I wouldn't say we're anywhere near the doldrums, but it's come in waves, hasn't it? Which perhaps to be expected, but we had a really strong beginning of last month, I seem to remember, certainly the end of the prior month. Now we're seeing a really strong performance in terms of flows in recent weeks. Why is it so choppy and changing in your view?
Yeah. So one thing that I think markets like is they like certainty. And if you look at over the last 4 or 5 months, we've had an election coming up. We've had interest rates that are at record highs for 20 years. And we've had a Fed that wasn't really ready to move. And we saw some softening economic data that was making it kind of tough for the market to pick a direction. If you look at where we are now, though, the market kind of knows where we're going, and that's giving us the room that we need to start repricing these assets higher.
Hey everyone, welcome back to another episode of CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance. I'm Ken Odeluga, Head of Content, and I'm joined as usual by my colleague, Gabe Selby, who's Head of Research. Hi, Gabe.
Hey, Ken, great to see you.
Guys, we are going to change things up from this episode onwards because the team is growing. We'd like to introduce our new colleague, Mark Pilipczuk, who's a research analyst, so he's joining Gabe in the research team.
Just a little bit about myself for all of our listeners. I just joined from Cambridge Associates. So prior to this, I worked in endowments and foundations. I worked in institutional asset management. And while I was there, I covered a range of asset classes from equities to hedge fund strategies to venture capital. But found my interest was in crypto. So I decided to make the jump and join the team over at CFB here.
Brilliant. So basically, this episode is going to focus on a new content stream. The team recently published their inaugural Market Outlook edition, Market Outlook Q4 2024, subtitled Recalibrating for the New Monetary Cycle.
I think it's good to give the audience just a quick kind of overview of
Sure.
When we think about how this piece of collateral, what our research is trying to accomplish, we view ourselves as a benchmark provider, firstly, to be as objective as possible in measuring markets, right? And we've done that with great success. We're very privileged. We're very honored to do that. Now, what Mark and I thought would be fun is to take that theme and kind of run it throughout the entire piece of the document, right? So when we talk about recalibrating for the next monetary cycle, one, that's a really big deal. Investors have got to be excited for this. This is, you have to wait a long time for Fed pivots, for new monetary cycles to begin. But what we'll see if you check out the document is, we're doing things like we're measuring the macro, we're measuring all the secular themes that we're seeing and the blockchain economies. We're measuring the crowd, and we're following that like overall theme of measurement. And in doing so, we hope that we can provide the insights to have something that's kind of an actionable takeaway. So we're providing also portfolio perspectives and things like that. But I'm happy to dive in. I'm really excited to have Mark on board, another fellow researcher here at CFB. So we're really kind of hitting the ground running here going into Q4. So I would say, overall, we're setting ourselves up for a pretty constructive outlook. And like we highlighted in our report, this is kind of like the first Fed pivot that we saw recently when Jerome Powell spoke in Jackson Hole, indicating that the time has come to begin to recalibrate their monetary stance, aka start cutting rates. The last time that happened was in November of 2021. If you can all recall, we were in this environment where we were anticipating inflation to be transitory, quote unquote, and it just did not end up being so, which created the most aggressive Fed rate hiking cycle since the 70s and 80s of Volcker era, essentially. So when we talk about recalibrating for the new monetary cycle, we're talking about a lot of different things, but mostly you have to just kind of appreciate the fact that, for the first time in a long time, this thing called "Don't Fight the Fed," that thing that is quoted, I think, in an exhausting manner, right, in markets. Well, we've been fighting the Fed now for quite some time, and it's come to a point to where it's time to recalibrate and time to consider the fact that we're heading on a different course now, and that's kind of what we're, the initial takeaway of where we're at here in Q4 2024. So yeah, I mean, I think it'd be really good. I mean, we got to talk about, our path, what we see for interest rates going, right? I mean, what's that going to do to the overall economy? What do we anticipate for money supply? These are things that, unfortunately, you're kind of constrained a bit when you're creating, a document that you're publishing on size. But on a long form podcast like we have today, we can dive right into it.
Yeah, and when it comes to thinking about our monetary policy, it isn't all interest rates too. There's also the Federal Reserve's balance sheet and what they're doing with that, with quantitative easing. Or right now they're in quantitative tightening. They're allowing $25 billion in bonds to run off every month. And what you're going to see as the policy shift continues to move from a more hawkish to a more neutral policy, you're unlikely to see that bond runoff continue. And should the economy weaken to the point where we might need easier monetary policy, we could even see the return of quantitative easing. And the liquidity that brings in has almost an outsized impact on these digital asset markets, where the supply and demand dynamics are different than equity and bond markets.
You're going to recall the, I don't know what diagram number this is, but it's got a title, Markets Are on a Steeper Cutting Path. So you remember this chart, basically 1 month SOFR forward curve, medium FOMC projection against CFB projection. And the point was, of course, that you so eloquently made, was that the market was like listening to the Fed and going, oh, we see this, this is our projection, blah, blah. I was like, oh, whatever. We actually think it's going to go lower. So that actually speaks to what you were saying, Mark, that we could actually, in the end, have outright quantitative easing. Could you actually explain a little bit more about that, though? The context, why the market is a little bit skeptical of the Fed's express projection and the implications of potentially a steeper cutting path?
Yeah, so I think it kind of comes down to a couple things. If you look at recession probabilities from some of the larger investment banks like Goldman Sachs, you've seen them announce that they're elevating their probability of a recession internally. So when you think about the way that these markets are, it's kind of probability weighted. So if you're anticipating a higher probability of a recession, what I think you're likely going to see is you're going to see maybe a 25 or 30% chance of the recession priced into the forward curve. And that could explain some of why markets might be pricing in a lower terminal rate. Because if we do enter into a US recession, it's unlikely the Fed would be able to keep interest rates at 3% if growth goes negative. You're going to need to bring interest rates under 3 and potentially even under 2 to really get the economy going again.
Sure.
So that's where that kind of comes from.
Gabe, what are the chances of that happening, though? I mean, I'm putting you on the spot. Of course, you haven't got a crystal ball, but is that your view, or is that your view that we are basically at a material risk of a recession, or at least some sort of like economic some sort of economic stress that maybe falls short of that?
Well, right now we are on the soft landing. I would say we're on the soft landing train so far. Of course, I'm always willing, and we're always willing to change our view given the data. And what we've seen in the data so far is, look, inflation's cooling, job growth is cooling, but it's not cooling materially enough to signal a red herring for a recession. GDP growth actually has been really stable. It's actually kind of, I'd say, been above trend. So we anticipate growth overall to continue to moderate lower along with inflation and along with job growth. But certainly we're not anticipating a recession right now. But what Mark made a good point I just want to jump back to, which is talking about the Fed's balance sheet. I think what people focus on a bit, or maybe they overlook this, is that it's not always so important just the nominal figures of what you're doing to the Fed's balance sheet, but also you should look at the rate of change. So if you look at what the Fed's done in their recent quantitative tightening, and now they're starting to kind of ease off the quantitative tightening, what Mark's talking about, potentially even easing off so much that you become purchasing assets. So it's QE again. The important part for markets and for investors is actually to understand the rate of change. If you're going from an extremely quantitative tightening path, which is what we had before, when you kept selling more and more, to a rate of change of where you slow off your selling and you stabilize that, to a path now where you're starting to decrease your selling. That's been very correlated with overall asset prices in the markets in general. So as it is with markets, they're very forward looking. And so you're constantly trying to get in front of the curve. And so that's why I think you see that dynamic. You don't usually wait until QE starts, right, for supportive price action. It usually happens, with economic data that could validate a shift in rate of changes, right? So, sure. I think that's kind of a key takeaway, and that's kind of what I would just kind of emphasize with that. But there's a lot of good stuff that's happening right now, and if you kind of go a little bit deeper, what I mean by that is, if you look at the change in M2 growth, it's already starting to pick up again. So we saw M2 money supply growth start to kind of fall off after the Fed started quantitative tightening. But actually, it started bottoming out and recovering at the beginning of this year. So we anticipate, I think, more of that M2 money supply growth when the Fed continues to kind of cut rates, which is what we anticipate for our outlook.
Sure. I think we're in sort of forecast territory right now, and clearly one of the most plausible frameworks to actually execute that for a team like yourselves is to have a number of scenarios. And I think this will be a good opportunity for us to talk about a number of scenarios that you propose within the outlook. I think it will be a great opportunity for you to actually extemporize on it, and of course to pinpoint what your base case scenario is.
Yeah, so I guess I'll start us off with the downside case here. Let's talk about the recession, the scary thing, right? Yeah. So the way that the recession case could kind of play out for all of this is we're really going to be watching the labor market. Right now, the labor market's sitting at about 4% unemployment, and we actually saw it tick down last month, but we have some layoffs and everything on the horizon in October. So we're going to see where that goes, right? The unemployment doesn't typically just go straight up. It'll move around a little bit, but it'll generally trend in a certain direction. So in the recession scenario, what you would likely see is you would see that acceleration of unemployment. If you think about times like 2020 or 2008, you saw unemployment, once it breaks above 5-6%, it goes pretty quick and runs to the upside. Now, the good thing for monetary policy in that recession scenario is recessions are typically disinflationary or even deflationary. You'll typically see prices fall as consumer demand goes down. So that gives the Fed plenty of room to respond. They can reduce interest rates as low as they want if there's negative inflation without them having to worry too much about restarting inflation. They also have a little more room to the downside on rates this time than they did in, say, 2020, because we had a lot of supply chain disruptions and shocks that were working against that demand shock from the lower rates to create inflation. The other thing that they have in their toolkit that they haven't brought out yet is the return of that quantitative easing. So they are able to purchase bonds to push the long end of the yield curve down, which will lower capital costs for companies and allow them to restart hiring or continue investing in growth to get the economy going again. The downside is during those recessions, it can seem relatively scary for markets in the beginning. So while there's the uncertainty of the magnitude of the response, as well as the magnitude of the growth in unemployment and the knock-on effects of the broader economy, you can see those sharp sell-offs. But the thing to pay attention to is always what's the long-term trend for what the Fed is doing. In the long run, remember, markets always have an upward bias, and these are, when you have assets with scarcity, right, you'll see more, as more money is introduced into the system, you'll actually see the value of those increase. You'll see the multiple you can pay for those assets expand.
My understanding is that your base case is soft landing. And in fact, if you go to the market outlook, guys, anyone watching or listening, go to the market outlook, scroll down. It's like pretty close to the top of the page under the heading Markets are on a steeper cutting path. One of the diagrams there is a scenario analysis. And basically, the base case is the soft landing with the declining inflation trend, economic growth trend, steady and no recession. But there are also a number of other scenarios. There are 3 other scenarios: hard landing, falling inflation, falling economic trend growth, and recession, yes. A third scenario, no landing, rising inflation, rising economic growth trend, and of course, no recession. And stagflation, maybe a bit of an outlier, rising inflation, falling economic growth, obviously the classic definition of stagflation, and recession, yes. So why, guys, maybe you first, Gabe, is your base case the soft landing?
The reason why we pick base case soft landing is right now the data is not showing us that we're seeing economic growth fall off a cliff. As a matter of fact, if we look at recession probabilities across these major economies such as the U.S., Eurozone, China, and Japan, they've gone materially lower since the start of the year. And we're starting to see actually a lot of economic surprises in the data as well. So that would be like data beating economist expectations, which is typically what you see in economic mini cycles, right? You tend to see the economy have these mini cycles within the greater cycles of recession and growth and boom bust, what have you. So what we're seeing here is maybe a pivot on the mini cycle, but we're not anticipating a boom again that we saw, coming out of COVID. We had a bunch of fiscal and monetary impulse. That's not what we're going to see. I think what we're just going to see is more of a sideways trend. But certainly, I've got some figures here that support, the things that we're seeing on the inflation side. If you look at the 6-month moving average of CPI, it's currently at 2.9%. A year ago, that was at 3.7%. Now, job growth has remained relatively robust. You could say that, but it's still slowing. And we've had, a pretty sizable print recently for September. I anticipate that October's non-farm payrolls will come in much weaker than people maybe anticipate just because of the hurricane, other disruptions. But we're still seeing the moving average, the 6-month moving average for non-farm payrolls growth decline from, let's say, 244,000 last year to about 166,000. So, one data point is one data point, but the overall trend still is intact. So we are sticking with the base case view for now. And I would say risks to that would be a material uptick in non-farm payrolls growth. I think that the Fed has shifted their focus from their price stability mandate to their full employment mandate. And if they get a sense that the job market's heating up, that certainly would probably dampen the probability of future rate cuts. So in that case, we'd probably be in more of a no landing scenario, not quite fall into a recession, because it's tough to have a recession, remember, if you have pretty good jobs numbers. But we're probably not going to get the inflation prints to start falling the way that we need them to see to get to that soft landing. So I predict a no landing is actually the second most probable scenario right now. And I would say hard landing and stagflation are probably tied at the bottom there. But that's kind of how we construct that viewpoint.
Sure. Given the scenario that you've landed on yourself as the base case, the most likely outcome for this quarter, what do you see the broad impact on the digital asset class?
I mean, overall, it's going to be constructive, but what we would advise is that, our outlook, being a constructive outlook, we view any near-term bouts of volatility as short-term buying opportunities for long-term investors. So we know digital assets are volatile, and there's two ways to combat that. You can size your position accordingly, so don't take too much risk that you can't afford. Don't over lever yourself. The second thing is to have a longer time horizon. If you have a volatile asset class and you have a longer time horizon, you're much less likely to be selling at a disadvantageous time. So that kind of puts us into that portfolio perspective that we wanted to highlight in our kind of more actionable viewpoint for our outlook.
Can I get Mark to give some contours or more specifics on them, maybe?
Yeah. So another thing to think about with the market volatility is to really focus on some of the secular themes. What are the things that are actually going to drive value for these tokens in the future? And on the development front and the user adoption front, we've seen some pretty impressive numbers over the last year. We've now, per a recent report out of A16Z, we're seeing almost 500 million global crypto users. And some of the things that we're seeing that are really going to help drive that adoption are really scalability on Ethereum and people using stable coins to pay. So there's these emerging market countries where they have less stable currencies. It turns out that having tokenized dollars on the blockchain that you can transfer for pennies has become a thing that's really unlocked a lot of saving potential for these people that otherwise were watching all their money get devalued. So I think that kind of focusing on that stuff, right? The real world adoption and not so much the day-to-day price of it can help you have a picture of what the real terminal value of this stuff is. And then you can evaluate its valuation today versus what its terminal value is based on number of users as well as use cases. And it really lets you cut out all the noise when you're thinking about it that way.
Yeah, I just want to say, Mark, why don't you give us a rundown, like what happened, recently? What was the main catalyst here that gave the, Ethereum blockchain? I think a lot of viewers that are active crypto enthusiasts probably know, and that's, the big upgrade.
Yeah, recently we had, back in April, we had an upgrade on Ethereum called the Denkun upgrade. And what that did is it took all of the layer 2 rollup data and it moved it off of the main blockchain. So it wasn't competing for block space with all these applications to a call data layer. And what that's done is it's taken the average transaction cost on a layer 2 from maybe $1 or $2 to under a cent. And that's the big unlock for a lot of payments. Because if you look at the most payments out there, you'll see there's hundreds of millions, if not billions of payments on traditional credit card networks every year. But most of these aren't large payments. They're under $100. And if you're paying fees of $1 or 1% of your transaction to do that, that's not going to be healthy or sustainable in the long run. So now that we've unlocked the ability to pay actually lower fees than what competitors out there have, there's a whole new wave of users that are now able to actually access this.
Sure. And we've talked about, top level scalability being, to use one of the subheadings of the actual report, scalability will take center stage. We've touched on that a little bit. Gabe, can I get you to talk about stablecoin use, which we also have touched on? That's probably one of the most evident secular themes that we're likely to see accelerating in this quarter. Why would that be the case?
Yeah, I mean, stablecoins for quite a long time, I've always kind of been showing the biggest volume, right? In any of these volume tables for digital assets. And that's just because, well, they're quite useful. I mean, if you think about it, for folks across the globe to have access to digital dollars is super appealing when you're living in a country where your currency is consistently being risked on destabilizing. So whether it's trying to send money internationally, having digital dollars on a blockchain has provided a real world use case that's had a lot of demand. And so we anticipate that stablecoin transaction volume is just going to continue to grow. We're forecasting it to land around around 16 trillion in total transaction volume. It's currently between 8 and 10 on any given point, and so we're wanting to see that kind of continue to grow up over the next few months. You'd say it's like a 6-month outlook. It's basically extrapolating the historical growth rates out into the future, and we've got a few different scenarios from a bear case, a bull case, and a base case, just like we did with our with some of our macro stuff. But I think another thing that I wanted to say with stablecoins is that and I think Matt Hogan from Bitwise has talked about this a bit, is that as these things get more adopted, it's not crazy to think that we will have a world where you'll find goods and services, in economies like the U.S. have stablecoin prices. And that's because when you look at merchant fees, right, whether it's Visa, Amex, MasterCard, they can be 2 to 3% of a transaction. And if you're in the United States and you've driven around, you've seen, gas stations having, a credit card price and a cash price. I think Matt's talked about this before in another podcast, but it's not crazy to think that one day you'll see a stablecoin price where you get a discount, right, for paying a stablecoin. So this is kind of like the bull case that we're anticipating in the long run. But in the near term, we're still seeing that upward sloping trajectory on transaction volume set to grow.
Gabe, I want you to continue, since you've got the hot seat, as it were, to get into another secular theme. And one of the ways that this stuck in my mind is that you guys pulled out one of the sort of really, white hot data from this report a few weeks ago and published it. It got published, got picked up by the press. And one of these is about tokenization, of course, what I'm talking about. With tokenized assets, so tokenized real world assets on the blockchain, projected to breach the $20 billion mark within the next quarter or the next year. I mean, I think probably next year, right? Do you want to talk to that? Yeah. Next year. You want to talk about that?
Yeah, absolutely. I mean, so Mark did, Mark, I got to give you credit. He's been instrumental in trying to get his arms around, what is the addressable markets for this type of disruption. And so we've got this great chart in our outlook that Mark, you came up with. I don't know if you want to break it down real quick, and then we can talk a little bit more about the tokenization trend and why we think it's going to go to 20 billion.
Yeah. So with the chart that's in our outlook, we have two figures on there. We have the first, which is a mix of the current global assets. So if you think about that as kind of a representation for the global market portfolio or where the world's capital is invested, you can see we have equities around $100 trillion. We have debt, a little over $100 trillion in the debt markets, and we have about $200 trillion in global real estate being the largest asset class. Now, all of these things are actually able to be tokenized on the blockchain, and we've started to see some of this with things like money market funds via BlackRock and Franklin Templeton, as well as we've seen mortgage-backed securities and private credit instruments tokenized. And that's only about $12 to $14 billion of tokenized assets now. And if you look at the mix of assets, it's mostly credit instruments, right? We don't have any equities, and we certainly don't have any real estate on chain yet. So there's tons of room to grow in almost every area for this.
Yeah. I mean,
Yeah,
I think
it's amazing.
our estimate in some regards, when you put it
It's
that
kind of
way,
light,
it's
really, isn't
kind of
it? Yeah.
conservative.
Yeah.
Especially when we look at all the players that are starting to consider getting into the game, all these other institutions. You know, we highlighted Franklin Templeton and BlackRock in our report, and we're certainly seeing more and more Wall Street traditional players, finance, you know, titans, start to explore tokenization. And, you know, for a lot of reasons, it just makes a lot of sense. I mean, you can reduce the costs of transactions significantly. You can fractionalize shares a lot easier. You can transfer them a lot easier. It's all on a ledger. It's the blockchain, which is something that has, you know, proven to just be a revolutionary technology. And frankly, you know, some of these legacy financial firms are still using, you know, these centralized ledgers that have shown to not be quite as reliable. So the efficiency and the transparency and it's all kind of appealing, right? One thing that I think is really cool too, that, you know, when we're talking about Benji and Buildle, which is the Franklin Templeton and BlackRock funds, is that, you know, these are basically money market funds, right? And everyone's probably heard of what a money market mutual fund is. And perhaps you've invested in it recently because the risk-free rate or the overnight funding rate's pretty high. So it's giving you a pretty good yield. And how that typically works is you have, you know, a NAV of $1 in the fund. And then every month it kicks out, you know, a dividend. And that's your interest that, you know, is being accumulated from the various short-term instruments that fund is invested in. Well, with these tokenized assets, you can actually see the interest accrue in real time. And as a finance nerd like me, I think that's pretty cool. I would love to just be able to check my, you know, my wallet and see, you know, the value constantly kind of accumulating, not have to wait until the once in a month, you know, hit that the, you know, or the transaction that gets sent out by the mutual fund company. So I think, you know, the world of finance is just going to continue to get faster and faster, and tokenization is going to be the key to get us there.
Absolutely. And this wouldn't ever, you know, this wouldn't be a crypto podcast if we didn't have some gnarly jargon to bring into the next and final major secular theme: decentralized physical infrastructure networks.
That's our favorite.
Abbreviated, thankfully, to DPINs, the lowercase e, PINS. Mark, what are these and why are they going to be so important in the next quarter and beyond?
Yeah, so what these decentralized physical infrastructure networks are they're what you could sort of a good example. You almost need a real world example for them to kind of break them down and understand them. One example of where a lot of capital expenditure is right now, and the thing that's on everybody's mind, is AI and the AI build out for all of the servers that are going to be needed to run these language models and image generation and all these other models. Right now, we're looking at potentially as much as $700 billion in annual CapEx for this by 2030. Now, most of this CapEx is being done by larger players, and what they're doing is they're deploying servers in large data centers all around the world, and they're charging for a server that might cost $500,000. They'll put you on a 3-year contract that might cost $900,000 to run this server. Now, a decentralized physical infrastructure network, so we can think of a project like the Render network, is going to take people. If you have a GPU that's capable of running these computations, you can list them on these networks and essentially act as your own cloud provider. And cloud isn't the only area this is in. This is also in cellular networks. So if you have a home internet connection and want to broadcast this to people to use their phones through, you can operate a piece of a cell phone network. And when you do this, it takes these markets that are typically large players funding large infrastructure expenditures, and it's almost like an oligopoly. They can kind of charge whatever they want so long as it's a similar price. And it turns these markets into much more perfectly competitive markets. Because now I, as an end user, can rent a smaller warehouse, and I can provide a different type of GPU that's maybe more consumer focused for these smaller companies. Because it isn't just large companies. When you think about something like AI, you have large companies that are funded with tens or even hundreds of billions of dollars that could spend forever on this high-end server stuff. But there are also those AI startups that are raising maybe $1 million or $5 million, and they need something that could scale better with the size of their business. And for the larger cloud providers, it doesn't make much sense to do that. The return on investment isn't there. But for somebody smaller that's operating maybe a small business that wants to get into this, it's a perfect opportunity and a perfect stepping stone to get into this.
Maybe we could get from either of you, or maybe both of you, why you think this is likely to be the opportunity inherent within DeepInd is likely to begin precipitating in the medium term, which is what the sort of forecast and the outlook implies.
Yeah, so I could just talk a little bit more on the cloud and what we're seeing and what we've seen over the last year. So there's a network called the Akash network, and what they do are they do GPU server and CPU server rentals. In the third quarter of 2023, when this was still relatively new, it only did about $25,000 in rental revenue. In Q3 of 2024, so the quarter that just recently ended, we saw that jump to about $300,000 in network revenues. So, which is, when you think about the total amount of money that's spent on cloud compute per year, it's likely to approach $1 trillion annually by 2030, 2035.
Sure.
And when you look at DeepInd's on-chain revenue for cloud for the whole of 2023, it was maybe $15 million. So if we get to 1% of the potential $1 trillion, we could be talking about a revenue growth from $15 million annually to $10 billion annually in a matter of really just a few years, because of how fast these crypto technologies tend to get adopted and how much faster they were adopted than older technologies.
If you had to take away one thing from the exercise of going through this quarterly outlook, your inaugural quarterly outlook, as something that you wanted to point clients, investors, anyone interested in crypto to, that you expected to happen, expected to emerge in the quarter, what would it be? Something to really pay attention to.
Yeah, I think one of the biggest things that I'm going to be watching going up for the next quarter is going to be how well Ethereum scales and in what areas it needs to scale. So I'll be watching stable coins, but I'll also be watching things like DeFi, tokenization, as well as the trading volume on these decentralized exchanges, with new things like unit chain coming out that could potentially improve that. And what I'm really watching is that going to start taking volume away from some of the centralized exchanges, and maybe DeFi is going to start really gaining some ground there.
Brilliant. And Gabe, would that be the same thing for you, or is there some other particular point that's a burning ember now that could actually become a flame in the months to come?
My one thing is, it's very simple. You gotta subscribe to our research and insights. Go to our website. I think there's a link down there. You can drop your email and hit subscribe. No, I'm kidding. There's a lot of stuff that's happening. It's really difficult to just do one. And I think in effort to make a lighthearted joke, I think it's not entirely responsible to distill it down to one. I think we've got a lot of things that are happening that are very, as we know, these secular trends that we highlight, and also this election. We didn't really talk too much about a regulatory outlook, but that's going to be probably pretty impactful. And also just, we got to continue to monitor what's going on in the macro, and we'll be on top of it here at CFB and ready to adjust our view accordingly. But right now, this is where we stand, and this is the latest from us.
So guys, there you have it. I hope that was as insightful and interesting for you guys as it was for us, and certainly for me. To grab that inaugural Q4 2024 market outlook by the research team that we've been discussing just now, you need to go to cfbenchmarks.com, and also other content produced by the research team and the content team more broadly, cfbenchmarks.com. For further podcasts, of course, search CFB Talks Digital Assets on your favorite platform. We have several up there right now. And of course, while you're doing that, be sure to give us a like if you're watching us on YouTube or another video platform. And do subscribe if you're listening to the podcast on one of the specialist podcast platforms, Spotify, Apple, so on and so forth. Aside from that, we appreciate you joining us for this episode, and we hope to see you soon for another episode of CFB Talks Digital Assets. Thanks for joining us.